Starting. All right. It's 8:30 and very gray day here in Maryland. I don't know what's going on. Good morning, everybody. Hi, Sam, Lucio, Glenn, John. I think I've hit Pavlo's bell on this one. Everybody's here on time. I know that this is a little complex. We're teaching economics and finance out of one bloodshot eye before 9 o'clock in the morning. So taking you back to those days in college when nobody wanted this. Good morning, Big Dave. Good morning. Scott's here. Good. Nelson. Good morning, Dennis. Good morning, everybody. Thanks for joining us this morning. Probably have about 100 people hanging out as usual in our morning room. I just shot some morning stuff that I will put into our report when it goes out, including some deeper analysis on oil prices. Again, CPI is this week. This is going to be a very busy week. There's a lot of noise, and we probably will see some shifts and changes in our figures as we move through the week. Good morning, Oscar, Florida Man, Bear Dog, Veronica, J Momo, Mike. All right, everybody's here. Fantastic. That's good. That's what we're looking for. I'm kind of going to simplify this a little bit this morning. We don't really have to go too overboard on this, but let me pull up a couple of things. I apologize. I was filming a lot of stuff this morning, including I read the 45-page report from the FSB on private credit, as you would expect. It's basically everything that we've been warning about for the better part of 8 months. They're just finally getting around to telling us everything that's happening. Let's just take a quick look at futures right now. A little bit of a dip, not much. 7,400 on the S&P 500, NASDAQ at 29. Once again, the same story over and over again. It's just a small number of stocks that are really doing the heavy lifting in this environment. And that's evident, of course, in our capital wave number. We are green. We were kind of chopping around with a little bit of yellow in the morning, but plus 55, 214, once again telling you this is all tech all the time. Breakout 43 to 7 on technology. Energy and utilities are the laggards. And once again, Intel, day 21, the stock is now up like 87% since it joined the Screamers list. AMD continuing its run, Datadog, Micro. Everybody is piling into the same stuff. TSCO is breaking down. Zoetis is breaking down. Charter Communications under pressure as well, despite the large amount of insider buying that we have seen. So it's all about tech. It's all about the melt up. It's all about the AI CapEx story. And it's interesting because the numbers, I'm going to put a video out later today on what is going on with the private credit and what the FSB has flagged. Again, the Financial Stability Board is not a group that just puts together a report because they want to. They are in charge of monitoring global risk. And as they point out, the single largest contributor to CapEx build out is private credit. Single largest. So where's all that money coming from? It's coming from people who don't even know that they are investing in it through things like insurance premiums that are being bypassed through the private equity space into private credit, into the CapEx. And again, this is where anyone who's saying that it can't be systemic isn't paying attention. It's just a reminder that they basically have told people that they have this safe annuity asset, and now all of that capital is finding its way into one of the largest financial infrastructure build-outs in human history that rivals, all of the other significant build-outs that have transpired that ultimately led to basically hitting a wall. So we got to be very conservative about that. We have to understand what the risks are. Remember, we are dancing near the door, keeping our eye on the door, and keep in mind that we talked about Warren Buffett. We talked about Berkshire. They're still selling stocks. They are refusing to participate in whatever is happening in this environment. They seem to see something that a lot of other people do not. On our launch pad, we got PRDO, CarMax, which tells you everything about where we are right now, and Sprinklr. So some of these names that are more speculative, CarMax does not feel like the safest thing in the world to me. But once again, who am I to judge? We are just but meat with eyes at 8:34 in the morning. On the other side on futures right now, you want to watch that dollar under 88.98. That lower dollar improves collateral multipliers and improves leverage. And we got to keep an eye on the MOVE index. A couple of things happening this week. President Trump is heading over to China, where they will likely be talking a lot about what's happening with Iran. In addition to that, the conversation will focus on market access and the continued capital and resource battle that these two nations are fighting. Silver price is continuing to move higher. Remember, my line in the sand every time silver pulls back anywhere near that $70 level, I have been a buyer. Gold is hovering at 4,700. It really is the dollar that is dominating everything. Bitcoin showing us that liquidity conditions look okay. And that once again, we continue to operate in an environment where conditions are loose and therefore risk is being taken at the moment. But obviously, we know that doesn't last forever. And we don't want to try to short anything until we see red on this. Here is our list since this first went live. We had this dip that transpired across the January and February period. We bottomed out right around the 30th. And then this is the momentum move that transpired, that crossover taking place on April 7th. Even though I was very against the expectations of this market, again, pay attention to the data because this is tracking flows. And this is a nice indicator of that forced buying that we heard so much about from Goldman Sachs. Same thing every day. Do it until it breaks. All right. On top of this, I'm waiting for one piece of data to flow in. I now have it. And now we can actually start cooking with gas. Here we go. Let's pull this up. Sorry. I had an old version of this and I don't like the current version. Stop sharing that to this and daily brief. There we go. All right. Key things. The VIX is at 18, which once again should blow everybody's mind, but here we are. The 10-year yield is currently sitting at 4.4. Brent crude above 103. And again, that Brent crude number is going to be important because CPI comes out. We also have PPI this week. That figure is obviously what impacts inflation expectation. Inflation's expectations impacts bond figures. Bond figures hit the move index. Move index hits collateral multipliers. And that's how you see that leverage unwind. Picking a direction. Okay, this is where we want to start paying attention to where we sit right now. Do we wait until we see red before shorting crashers? I mean, look, I think if what you're asking about, this is very important. I've said this a couple of times. When it comes to the companies that are considered crashers, what I recommend doing is you want to follow the trend. The trend is clearly to the downside, right? You continue to see that these names are under pressure. The thing that I recommend, the thing that I advise people to do when you assess these crashers, or if you're in the elite, you have access to the development side, you have the conviction engine. This conviction engine right here is all of the stocks ranked relative to one another on momentum. If you are shorting names like McDonald's or MasterCard or Brown and Brown, these are the weakest momentum stocks in the whole thing, right? The weakest momentum in the whole thing. The key thing to keep in mind is you have to define your risk. And the way you define your risk, if you're taking one of these crasher stocks, so let's just say TSCO, right? TSCO continuing to break down. This hit the list, I think, like 2 weeks ago when it really started. The way to trade this is to do spreads, okay? I'm going to stress this, spreads. And what you're doing is you're buying a put and you're selling one out of the money. So you're buying at the money, selling out of the money. When you do that, and remember, you have access to an option calculator that we built right here. It lays out your probabilities. You set a tight stop. You define your risk at a key moving average or on a daily chart, whatever it is. But know upfront, this is what my potential win is. This is what my potential loss is. And you stick to it. And that's it. So yes, you can continue to follow the trend lower. Again, this is about momentum. Weakness creates weakness, just as strength creates strength. TSCO continuing to break down. I would be shorting it until we see a cross on this MACD. This MACD is starting to narrow a little bit, but this thing is deeply oversold. So I'll probably sit that one out. Just a key thing to keep in mind. The other thing to note, everybody over at Elite, we do have this liquidity thing that we built. So we're still working on this. This will ultimately come over to people who are members of the Standard Money Printer Pro. We are building something to measure treasury plumbing, financial conditions, momentum, and flow and news. It's going to take a little bit of time. It takes a little bit of time to get this stuff right because, as we know, we were going to launch everything in August. We kind of got our timeline moved up. We need to make sure that all of these bells and whistles work because the last thing that I want is some data set out of the U.S. Treasury Department to go awry and all of a sudden it looks like they're buying something when they're really not. Oh, and by the way, as you can see, Federal Reserve assets went up last week, $114 billion. Funny how that works. Treasury General account went down 112, 122. Funny how that works. That's not a bad thing, is it, for the equity system at all? Momentum, flows, raw data, etc. This will all be coming out probably in mid-June. Give us a little bit of time, please. This is a very time-consuming event, and it's just two people doing it all. I do want to remind you of that. All right, and largely Scott. So everybody give Scott a round of applause. We'll go from there. All right. So time in negative momentum is pertinent. Yes, it is, because once again, the reality is in the elite group, right? So if you take all 502 stocks in the S&P 500, they will kind of bounce around positive and negative and like a various score. But the key thing that does matter is the fact that momentum creates momentum. So Intel being on a list for 5 to 6 days is more important than Intel meeting it on the day that it adds. And again, you start to see that mechanical buying start to kick back in. Key things we want to focus on today. Once again, the poll shifted Friday, mega caps and semis doing the lifting. Reading pulled back a little bit late in the day. So we are very stretched. We are at levels that we saw back at the beginning of January and at the beginning of November before some broader momentum sell-offs. But once again, $600 billion has moved into the system going back 6 months, according to Cross Border Capital. It's very clear that they are running this thing hot. Anchors are very strong across the board. This is direction finding. It's not breaking. So this can mechanically continue to build. This is that feedback loop. Futures remaining flat, oil higher on the Iranian headlines. But we're not at this point right now where the narrative is completely shifting. I think the narrative is going to start to shift again because people are going to start to worry about private credit again after the FSB report, which again, I dug into pretty deeply. And the FSB basically just came out and said, guess what, everybody? We can see the wires, but we can't see the bomb. That's an issue. The Fed's still buying $20 billion a month, $25 billion a month in T-bills. The Treasury's still running buybacks. They're still paying down that TGA. The markets are shaking off everything. We're at all-time highs. This can go on longer, a lot longer than people can expect. And I like to just stress that, there are these periods where people are tempted to try to time the market and try to short everything, even in the face of what looks like extreme momentum. And we are at a point right now where momentum remains extraordinarily strong. And I will say, from a lagging perspective, the SPY, you could see that we are overbought on the RSI. But pay attention to the fact that the MFI is not overbought. So I don't like to try to take a shot to the downside until we actually see those conditions stretched. MFI is a measurement of price momentum, but also volume. So we want to see a lot of volume. We want to see this push toward these highs. And then if you want to take a shot to the downside, you can bet small and look to go out of the money. And this is kind of where the Spitznagel approach to markets comes in. You get into this extreme overbought territory. You see the RSI above 70. You see the MFI at 80. And then what you can do is look at the MACD. If the MACD starts to roll over, right? If the MACD starts to move into a negative histogram, that's where you go out on the options chain a month and you buy whatever is $1 on the put side, because it still is extraordinarily cheap right now to short. And everybody is max long, but it needs that one headline. You need that kind of risk off event. And it does feel like the market's going to get there as we move later in the month. And what I mean by this is you just wake up one day and everybody says, you know what, we're taking profits. This is exactly what happened with oil back in January of 2022, or forgive me, June of 2022. We just suddenly saw hedge funds just say, you know what, we're going to take all the gains that we have made on oil. Even in the face of higher prices, it just got absolutely whacked. So it's important, again, to watch the FNGD, right? The FNGD is showcasing us the leverage in the system itself. The FNGD is extraordinarily beaten up. It has pulled back to levels that we haven't seen since before that November period where we had that big drawdown and ultimately Japan had to step in and provide support. We have Japan currently going through its situation right now where they are intervening in their currency. And the last time that they did this at the scale was, sure enough, back here in 2024, where we were at levels on the FNGD that we hadn't been, and then we sold off into that huge downturn. So those risks are still there, but it all happens at once and it happens quickly. And it's just a reminder that, it is summer. We are moving into the summer. I want you to simply check in every now and then, have this up on your phone, have this on your computer, check it once a day. Check it once a day, because at some point, what happens, and this is important, this happened on April 6th. All of a sudden, we went from minus 50 on the EW to basically zero because we strained ourselves. We just basically got to the point where nothing was selling off in a frequent momentum breakdown anymore. And then we just kind of moved to equilibrium, and then the mechanical buying really kicks in. The same thing happens on this side as well. That's what happened in January. It's what happened in November of last year. It happened in October. It happened in April of 2025. It happened in August of 2024. The drawdowns are faster and they're more severe. And it all goes back to the plumbing that we talk about on a day-to-day basis. Now, I'm going to answer questions in a little bit. Let me just get back through this so we can move through our day. Key things, again, on picking a direction. We're not there yet. Market shaking everything off. All net additive to the big picture. Stocks at highs despite the consensus. Now, the VIX channel and the FAZ watch. The VIX at the top of that recent downtrend. We've shown that chart multiple times. I want to pull that up real quick. So let me go to my Substack real quick and pull up that article that we put out. We put this out every morning just in case everybody does not know. We put out the article at 8:25 that has all of the insight that you need for the day. So what we talk about here is this chart. And this chart is our VIX screen. And this Scott is a master of this, by the way. So this was the channel that we were following all February and March, right? We saw that move. We popped up to the top. And again, this was drawn out, by the way. Like, we didn't do this in the rears. We literally just drew this thing out as far as it went, and it kept tapping these key resistance levels. Then all of a sudden, we move into this down channel, and the VIX has been doing this since. Why is that relevant? It's relevant because of the nature of the way volatility funds operate. So as VIX drops, those groups that are volatility focused start to lever up and they start to bid more, and it's mechanical. So this buying is not based entirely on that narrative that you see on CNBC, which is, hey, everybody's bullish about CapEx and everybody's bullish about AI. No. This is about the nature of the mechanical purchasing and the way that the markets have evolved over the last 15 years. It's not just about people chasing in retail. There are mechanical buyers, there are CTAs, there are other participants. So we're at the top of that channel, and the expectation should be toward a continued decline in the VIX, moving the other way. But we're going to continue to monitor this, because if we do break out of that channel and we start to go in the other direction, it could be the start of something significant. If we break that trend higher, we have a different conversation. For now, long, high beta and tight stop. And once again, the interesting thing about what has transpired in this rally is that this rally, with all of this injection of capital that has been coming in and all of the focus on momentum and liquidity, what's transpired has actually kind of been what feels like the how four-step process of how momentum and liquidity operates and how it impacts specific asset classes. So I've gone back and I looked at it, and remember, how has this model, cross-border capital has this model where they say high beta first, then you're moving into financials, then you're moving into speculation, and then you move toward the duration where you start to focus on bonds. Well, the interesting thing is that every time that there is one of these injections, every time that there is one of these loosening of credit conditions, the high beta stuff is taking off right off the bat. And that happened in November. It happened back in August 2024. It happened in April of 2025. So the reality is, and I want you to remember this, if we get into one of these events where the market pulls back, we hit oversold, it's not going to be about buying quality. It's about buying whatever piece of shit, sorry for cursing it on a Monday at 8:50, but that's really where we are. We're in an environment where junk is rallying and quality is getting beaten. High beta is rallying, but Warren Buffett and Berkshire Hathaway is lagging. That's the market now. So we're watching the FAZ. That's the confirmation chart. The 8-day EMA is poised to break above the 20. This is a very important thing to be watching right now because once again, it's not just about the FNGD, it's also about the FAZ because that is the banking space. And we want to be watching this because we want to be reminded once again that there are cracks in the financial sector that still are persisting. Private credit right at the front. Remember, all that private credit on CapEx is still there. So watch the FAZ because we have had events in the past where the FAZ has moved much, much higher. The banks have broken down, but at the same time, the leveraged stocks were still holding up. The perfect example of that was back in March of 2023 when the Silicon Valley banking crisis happened. The banks got beaten up, but the big mega cap stocks actually lagged that sell-off. So the FAZ is just as important as the FNGD. And we want to be watching this because this could be exposing potential cracks in what's happening in Japan, what's happening in the bond markets, what's happening in the insurance industry, and of course, what's happening in private credit. And once again, I remind you, this stuff does not hit the headlines for 2 to 3 weeks. The selling or the pressure builds now. It starts to persist. And then people wonder 2 weeks later, well, what the hell happened? We tend not to find out until, well, again, once the dust has settled. Here's the BNKU, which is the big bank leveraged ETN, hovering right at its 50-day moving average, which is why we want to watch the BNKD. Oh, isn't finance fun? All these weird things that exist. See that candle? That's interesting. This had a crossover positive on its MACD last week. So something's happening. Something's building in the banking system. We don't know what it is yet. We have to just pay very close attention. It could be just a head fake. Could just be some profit taking. Could just be, hey, we're just, kind of rotating out of the banks. But for right now, if we break above that 50-day moving average and the VIX starts to move higher, we have an issue in the market. The FAZ has rejected the FAZ and the VIX stays in channel. Markets will likely continue to drift higher. This is the chart that we're watching closest right now. So what's moving? FICO. Hey, Launchpad, poised for breakout, expensive name, tokenization, and a regulatory play. Stuff that's breaking down. Mosaic can't get out of its own way. The fertilizer space, that name is just not finding traction despite the fact and the expectation that prices are going to continue to move higher across the space. Mosaic can't get a break. So this is a really interesting situation right now where we're hearing all about higher food prices, right? Higher food prices in the year ahead, higher fertilizer prices, and it's not going up. It's not going up. Pay attention to this. Watch CF. CF had a relatively okay earnings report back in Q1. But once again, note this, that some of these names still don't have access to certain materials. Some of these companies are brokering. Some of these other companies are facing higher input costs. And if their input costs go up, then their output costs, their margins are still going to get beaten up a little bit. So I want to remind you, like you're hearing the headlines, you're hearing all about the food crisis, you're hearing about this, trend, and your first mindset would be, I got to go out and I got to buy Mosaic, or I got to go out and I got to buy CF. It ain't happening. We've already seen that rally transpire, and now the profits have been taken. And this is a reminder of how narratives operate and how things can go in the opposite direction. Remember, we had that huge move up in the oil prices. And I told everyone, listen, for end of April, end of March, I said, you got to watch the OIOU. If it breaks under the 20-day moving average, breaks under the 8-day moving average, this is institutional players dumping oil positions. Now, the OIOU is starting to make a little bit of a rebound. I want you to watch the OIOU right here. I want you to see that MACD. See the negative 6.69? If that turns positive, you're going long. Names like APA, names like Devon. You can trade. You can set up call spreads however you want to do it. But you want to be looking for that positive shift on that histogram on the MACD for the OIOU, and hopefully at least the RSI to break back above 50 so that we start to see some level of support. Okay. Now, once again, remember, narrative versus price trend. It's all in the technicals. It's all in the numbers. Conviction, KKR, Visa, SBGI, and ICE, all major insurance names We like this stuff for the very long term, but we have to recognize that KKR is under some pressure because of private credit, Visa, and again, questions about what's happening with the consumer. This is stuff for the long term. When we start to look at the digitalization, this is going to be very interesting. ICE has filed for a 24/7 tokenized markets. The SEC has approved the sandbox. Nothing is stopping this trend. And under pressure from the carry trade unwind and private equity stress, that's not going to last forever. Once again, write these names down because as we move into this new financial architecture, these are going to be some of the key winners. Key thing to keep an eye on right now, the 10-year up 2 basis points to 4.39. The Mideast tensions obviously are going to be in focus with oil prices continuing to move, and the CEO of Aramco saying that markets won't normalize until 2027 if Hormuz stays closed. Gold has dropped a little bit. The stalled truce keeps inflation elevation risk elevated. From the Fed, the private credit redemptions are manageable, they are saying. They're warning on a pinch for riskier borrowers. The FSB report, I promise you, says different, and it suggests different. This is once again the Federal Reserve doing what they do, arguing that things are contained. I will tell you right now, it is not contained. There is very clear things in that FSB report that people need to really understand. And once again, it is the same story over and over again, history rhyming a little bit. This is not 2008. But once again, it is a process of a lack of opacity. And the FSB report, I think, completely contradicts what the Fed is stating. BlackRock's filing 2 tokenized money market funds for stablecoin holders because why not? Remember, Larry Fink said the other day, everybody, he thinks that the tokenization path and the electricity path is the way forward. And he is there to do it, to sell it to you through money market funds and ETFs. Thanks, Larry. Really appreciate it, bud. Heavy lifting, the smaller numbers are doing all of the work, or forgive me, a smaller number of companies are doing all of the work. This is the 6th straight winning week for the S&P and the Nasdaq, and the longest streak since 2024. The pulse is cap weight positive. That's important. Equal weight is negative. Pay attention to that. Mega caps are carrying. The Russell is the exception. It is the broadest daily participation. We have the CPI number tomorrow. We're expecting hot at 3.7%. This is starting to meet my expectation that they have effectively capitulated on 2%, and they're just going to let it run hot at 3. For a while, this was not just me making that argument. You had people like Paul Krugman arguing that they should just accept a 3% target not too long ago. The bond market gave payrolls a pass on Friday. Nobody really cares. CPI is what matters. I will be digging through CPI tomorrow extensively because it is an extremely important report, and there's going to be a lot of information in there. The insider buying to selling is extremely weak. The MOVE index is in the low 70s. That's the loosest in months. It's been persistent. The TGA drawdown pushed fresh reserves into the system, and conditions are the loosest in months. Remember, the economic conditions index is basically just a inverse chart of the S&P 500 because the markets are largely tracking liquidity expectations. The Fed Financial Stability Report system is holding together, but stress is still under the surface, and hedge fund leverage is extremely high in the upper quartile. Heavy flag AI investment increasingly funded by debt. Working both sides of the trade this week, again, we got Bessent meeting with leadership in Japan. Then we got Trump going to China. The yen carry trade is in focus. It's close to $1 trillion spread across treasuries, private credit, insurance, and leverage. Orderly unwind would be manageable. A disorderly one would touch everything and look a lot like what happened in late July and early August of 2024. Last week, state insurance regulators on private credit exposure had conversations. This week, Japan and other major holders of bonds are working both sides to prevent a systemic thing. Again, CPI this week, Bessent in Tokyo, the Xi meeting, the VIX is at the top of the channel. Will we break it or reject it? The FAZ has its 50-day test. This is a confirmation or rejection of problems. And the SpaceX IPO and Ackman public, deal flow says expansion. We have Fervo going public this week as well. One of my favorite companies, but I don't know what the valuation is going to look like at this moment. Names like Devon Energy will be trading in lockstep with it, as will HP as well. All right, let's dive into any questions that you have. This one a little longer than I was hoping. Let me go through some questions and some comments real quick, and we'll go from there. We already answered that. Okay, time in no negative manner. Yes, I can't wait until has a time wait. Okay, we can obviously do that. Thoughts on what metals are saying about the Fed? Well, silver's interesting. I'm still increasingly bullish on silver. I just sit here and look at this right now. I don't think that metals really has much to do with the Fed so much as I think this is an oil story at the end of the day. But right now, 4,700 on gold, and monetary and fiscal expansion are continuing. And I think you're seeing that in silver prices right now, platinum back above 2,000, and copper expanding. Copper is moving higher, but one of the key things that's interesting about it is the fact that the People's Bank of Japan, China really isn't doing much. The question really comes down to, I think, what the PBOC does moving forward. They were one of the key stories that we talked about in our risk outlook for 2026. And the big question was, how much money were they going to pump into the system? What would the impact be on copper? What would the impact be on oil? I mean, if China wants, they can just absolutely drive this thing parabolic. If you watched the Hal discussion last week, he was noting there's a very strong relationship between gold prices and the PBOC rather than what's happening with the Fed and the Treasury. So I think that that's really going to be the more important thing moving forward. The questions about what China's going to do to maintain its economy. And in the event that you start to see China's economy start to buckle and bigger questions about the yuan, if they start to loosen or they lower their currency, what does that do to metals prices? That's going to be the big wild card, I think, moving forward. We're going to have to pay close attention to that. And once again, we're paying very close attention to Japan's interest rates because my big concern remains the same. Cross-border exits. If capital leaves the United States, what does that do to the leverage here in the U.S.? Not a good time to deploy fresh capital. Fresh capital can be deployed, I think, to choke points, things like pipelines, things that are really the things that are owned by sovereign funds. I think that that's the cleanest way to focus on this. How do you find things that can be deployed and reinvest, particularly, average down, weight down? I'm not touching anything in the softs department. People keep asking me about wheat. One last thing I'm going to really request out of people, please stop asking me about stocks that are at all-time highs or 52-week highs, or really RSI in the 70s and the 80s. I really can't tell anything out of that except, hey, it's overbought. Maybe you want to sell some calls on the existing position. Maybe you want to sell some spreads. Maybe you want to take profits. That's going to just be a rule. We're going to create a rule in the morning, and it's going to say, hey, you're violating the rule. And then I'm going to hit a button, and I'll have somebody yell at you in my little board. Time to get a shopping list together. I agree with that. How long to hold? I have a list burning through in my pocket. NFCI and GB's ratio are great timers. Thank you. Whispering Candle's got a lot to say today. I appreciate it. Is KNSL a good buy? So I like Kinsale, but once again, as we know, this is all private credit. This is all deeper concerns around insurance. So, Kinsale is something that I own. I've been very transparent about that. Love the company, love the business, but right now, given the current state of affairs, absolutely beaten up. I would try to steer clear of insurance right now. I would wait until we saw at least some sort of continued commitment toward capital expansion and stability out of private credit. This is where the momentum. This is where our cycle, according to Cross Border, kind of topped out. A couple other sources stating the same in terms of the liquidity cycle, but obviously the liquidity has expanded above $190 trillion according to the cross-border capital numbers, but this has pulled back pretty significantly. So what would my entry point for Kinsale be? This is going to be a very funny answer to you. $150. That's where this could potentially go. It depends on how significant this is. And once again, people keep saying that private credit isn't an impact on insurance companies. Well, Kinsale would beg to differ. AIG would beg to differ. Berkshire would beg to differ, it seems. But then, pay attention to the other big players that own those names, the BlackRocks of the world, the Blackstones of the world. Blackstone at 123. Remember, significant insider buying back here at around 100, 123. And I like Blackstone a lot, but right now, good grief. Look at this. These numbers are monstrous. And once again, the cycle for this is expected to really blow out in 2027 over $1 trillion in AI infrastructure. Question's really where's the money going to come from? And it looks more and more it's going to be coming from a lot of places that people are going to be getting creative. Kinsale will be under pressure. I agree with you, Minshew. All right, BRO, same problem, right? Same problem. So Brown and Brown, this is one of the weakest stocks on the momentum signals lines that we have. Extremely weak. I think it's one of the worst performers, if I'm not mistaken. What's up in the devs? 502. Dell's the number one stock again. Good grief. Over Intel. Wow. So this is across 7 different momentum signals. It's an academic approach. Strong trend, deep liquidity, very low fragility. Brown and Brown's the worst. Marsh is 2, Arthur and Gallagher, Willis, MasterCard, Intuitive, McDonald's. McDonald's. Wow. Oh, good old McDonald's. Berkshire's under that pressure too. Berkshire can't get off the ground. But I mean, there's a lot of weakness here. Sherwin Williams, T-Mobile. I mean, there's just no strength here, and T-Mobile's probably going to continue to see weakness as we move toward that SpaceX IPO. Because once again, I think that if you were to have a conversation about what are the stocks that lose money that move into SpaceX, yeah, we've already talked about the fact that a lot of money will rotate out of the Mag 7 because of the market capitalization issue. Keep in mind that a stock does not have to be kicked off of the NASDAQ 100 for a short period of time. But I think it's going to actually draw a lot more attention to names like T-Mobile and Sprint, and the other players in that space. Sprint's not public anymore, but AT&T. Why? Because Starlink, their EBITDA numbers are just monstrously better than all of the what would be considered the competition or the comparative names in the space. That said, as you know, I don't really care too much about care for the SpaceX IPO, and I think it could be a major problem in the financial markets moving later this year, particularly when you have a stock where you have continued contraction of float, and you're going to see a huge chase on this stock over the first 15 days, most likely, and then we go from there. Valuation is just absolutely insane. So thank you very much. If you haven't watched that video, please check it out. There's a couple other pieces that I'll be doing on this soon as well. I did a video on it over the weekend. In addition to that, I'm going to do something that's a little bit shorter later this week. All right. So tomorrow, just real quick, so everybody remembers, CPI comes out in the morning. That is going to require us to do a dive into that report. I'll tell you exactly what we're looking for. If you have questions, again, this will go out probably around 15 minutes from now. I'm going to run a copy, run through everything for our current what do you call it, transcript. And it is Monday, is it not? And we will go from there. Mitcheru saying, I'd argue that private credit isn't the driver for short tail insurers, more of life and casualty players. Yes, that is true. It is life and casualty. But once again, it's all about perception. And names like AIG are under a lot of stress, largely on the backside of a lot of events that are transpiring in Japan. All right, everybody, I'm going to jump. I hope you have a great day. If you have questions, you know where I am, and I will go from there. There's going to be another video that will come out. I'll throw it in as well. That's just kind of our recap and our views on what's happening in the broader market. Let me make sure that I have this. Let me see. Is this it? Credit. Private credit. And the other video is right here, and this is my breakdown on what's going on with Trump and Iran. All right, take care. Talk to you in a bit. Stay positive.